When the markets closed on Friday, the S&P 500 and the Dow Jones Industrial Average hit all-time highs. The S&P was up about 1% from the day, but all of this is entirely driven by low interest rates. See, the Fed has created a massive bubble in our economy right now, and earlier this week, the Fed cut rates from 150 to 175 basis points. That's 1.5% to 1.75%. That is really, really low, even by historical standards. But meanwhile, you have Trump out there saying he wants zero interest rates. He put out a tweet that's utterly ridiculous, and he said, the Federal Reserve should get our interest rates down to zero or less, and we should then start to refinance our debt. Interest costs can be brought down that way. Well, I agree with the sentiment of refinancing the debt. Currently, all the debt, or the majority of it, is on short-term maturity T-bills, meaning this debt, it has to be refinanced every single year. So that wouldn't be necessarily bad if Trump lengthened the maturity of the debt from T-bills to T-bonds, but you should not be asking the Federal Reserve to get rates down to zero. We don't want to be like the rest of the world in Sweden and Japan where they have negative interest rates. This is negative nominal interest rates. That's not even negative real interest rates. See, the Fed is putting out these targets with 2% inflation and 1.5% interest rates. So we still have real negative rates. We don't want that for our society. Society improves when interest rates are higher. It encourages saving and investing. Interest rates are set or should be set by the market. There shouldn't be the Federal Reserve setting these prices and setting these targets for interest rates. It should be determined by the supply and demand for funds. When there's a lot of savings and investing, people will flock to government bonds. When the price of government bond goes up, the interest rates go down. This means there's actually savings to back these loans. We don't need these boneheads in the Federal Reserve and these bureaucrats setting artificial interest rates too low, propping up these government bubbles. This is exactly what happened with the housing crisis before 2007. We had Greenspan and the Fed putting interest rates at 1%, so the interest rates in a real term were negative, encouraged all these knuckleheads out in California to buy homes. In Greenspan, his thought process was, we want to prop up the stock market, prop up the house values, so people will think they're rich, and then they'll go out and spend money. That's putting the cart totally before the horse. The stock market appreciation is not supposed to be the source of wealth. Just appreciating home values is not how people are supposed to get wealthy. The price of a stock is supposed to be determined by the present value of your future cash flows. So it's supposed to be productivity drives, companies that are creating value. And when you're creating value, that makes your stock price go up. Just simply lowering interest rates so that in a relative valuation sense, stocks are more valuable, that doesn't do anything for the economy. That doesn't do anything at all. That's just totally putting the cart before the horse. And we've seen this with some of these tech IPOs getting absolutely slammed. Chewy, Smile Direct, Uber, and Lyft. These are all massive money-losing companies. But with the Fed keeping interest rates so low, it makes these asset classes seem more valuable than they really are. Uber even put it in their 10Q in their prospectus that they have no expectation of ever becoming profitable. Now, think about this logically. Why would you ever invest in a company that has no expectation of turning a profit? If you're doing this from a stock equity standpoint, you might be thinking, well, they're not profitable now, but they might become profitable in the future. But this is still ridiculous. Uber is coming out here and they just lost this massive lawsuit in California where they're going to start having to classify their drivers instead of independent contractors. They're going to have to call them employees. And in their 10K that they issue annually, it says there's a whole section called risk for investors. And they say, we have incurred significant losses since inception, including in the United States and other markets. We expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability. May not achieve profitability, they're openly putting this out there. So all this cheap capital that the Fed's provided with these low interest rates is keeping cheap money flowing into these toxic asset classes that really aren't assets at all. Uber, Lyft, Chewy, Smile Direct, These companies probably have market caps of around $100 billion, but they're not assets at all. And someone's asset is someone else's liability. So when these assets theoretically go to zero because they're never going to turn any profit, and thus there's no present value of future cash flows, this means these stock prices are worthless. They're absolutely worthless. They had 91 million users, but they're slowing their growth rate. Uber and Lyft just keep taking market share from one another. And right now their business model is they're selling services that are priced less than what they actually cost to provide. So if taking a ride on Uber, if I go and I'm in downtown and I need to get to my home in the suburbs, and I order an Uber and it costs $15 for this ride, well, the real price of that ride is probably $20 once you account in for the driver's wages, the insurance, the depreciation on the car, the gas, and the taxes. They're providing a service for less than it actually costs. And so if I have a business and my entire business is I have $20 bills and I'm selling them for $10, I'm going to have the biggest business in the entire world. Everyone's going to want to do business with me. Heck, if you do business with me, you're making $10 on every transaction. But with that $10 I'm losing, I'll make it up in volume. I will make it up in volume. And the ironic part of this is actually the more transactions I do, the more money I'm losing. And that's exactly what's happening with Uber. The more volume they're doing, they are losing more money. And this whole lawsuit coming out of California where they're going to have to consider their drivers, employees, not independent contractors, that's just going to result in significant additional expenses. Their business model's done, their financial conditions. I'm curious to see when their earnings come out next, what they're going to be. Now, these are tech IPOs, so at least when you own a stock, they may not be profitable now, but you have the possibility of turning a profit in the future. Meanwhile, around the globe, we have countries issuing negative nominal interest rate bonds, not negative real interest rate, negative nominal interest rates. I think Japan has a negative 0.4% bond right now. Now, the only thing worse than investing in a money-losing company is investing in a money-losing bond. See, when you invest in a negative interest-bearing bond, you are absolutely guaranteed to lose money. 100%. If you hold this bond to maturity, you are going to lose money. It is ridiculous. And the only way that someone can justify buying one of these negative interest-bearing bonds is that they expect interest rates to drop even further, and they're going to sell it to some other sucker who's going to then try to sell it to another sucker for less money. And so what happens is someone guaranteed has to lose money. Someone has to pay the piper with these negative interest-bearing bonds. And so what the Federal Reserve and central banks around the world have done is they've created such low interest rate environments that when the next recession comes, and it's coming, the Fed is going to have no tools to fight the inflation. Their playbook anytime there's a recession is they cut interest rates to zero, they quantitatively ease, they cut spending, and you restructure your debt. Also, these four put together, they're called a beautiful deleveraging. Well, back in 2006 and 7, interest rates were at 5%. So when we entered into the recession, they could cut them from 5 to 0. We're already at 1% right now. Cutting interest rates from 1% to 0% is not going to provide the stimulus that our economy needs. So what are they going to do? The Fed's going to go back to their printing press and just start spewing out government bills. They are just going to print so much money to the likes that the world has never seen. Right now, the Federal Reserve's balance sheet is about $4 trillion, And they told us after the 2007-2008 recession that they were just printing money and that quantitative easing was temporary and that they were going to be able to shrink their balance sheet. But that never happened. Their balance sheet never shrunk. We're sitting at a $4 trillion balance sheet right now. The Fed will not be able to cut rates to provide stimulus in the next recession. So what happens if the Federal Reserve couldn't shrink a $4 trillion, $5 trillion balance sheet? How are they going to shrink an $8, $9, $10 trillion balance sheet? That's nothing. The dollar is going to be a bottomless pit at that point. And we already know that the government's not going to cut their spending. There are so many unfunded obligations out there. Everyone wants free college, free medical care, free child care. But the government's going to print money into oblivion. And so we've already started with this. We started QE4. Now, Jerome Powell won't come out and say that this is QE4. But the Federal Reserve Bank of New York last week added $104 billion in temporary liquidity to financial markets, and this is expanding their balance sheet. So while they're not calling this QE, it is QE. These are just repurchase agreements. The Fed has this operation for 13 days that are going to take in $31 billion and another $73 billion. So all the Fed is doing here is they're popping up another massive bubble. They're just printing out money, and what happens when the Federal Reserve creates money? It leads to inflation. Now, a lot of people think inflation is just prices going up or down, but prices cannot inflate. The only thing that can inflate is the money supply. Prices go up or down, the money supply can expand, and an expanding money supply is what leads to prices going up. And the federal government is already sitting, I think on Friday or Thursday of last week, the federal debt topped $23 trillion. I remember back in 2007, 2008, the federal debt was at, $7 trillion, $23 trillion, and the government is sitting with this $23 trillion. It's all financed with interest rates between 1% to 2%. What happens when the Fed, that's printing all this money, creates massive inflation and prices are rising, which is what happened in the 70s, in the 60s and 70s, when we spent all this money going to the moon on Lyndon Johnson's Great Society. What happened was you had double-digit inflation rates in the 70s. You had prices rising at 10, 15, 20% a year. So what did we have to do? Paul Volcker came in with the Fed and jacked interest rates up to 20% to fight the inflationary cycle. 20%. Now, we live in a world right now where the Federal Reserve, honest to goodness, thinks that interest rates can never go up, that they're going to be low forever. They're going to be at 1, 2, or 3%. Well, we've already seen inflation right now is rising. It's over 2% a year. It's approaching 3% annualized. So we're creating a massive inflation spiral. And what happens if we enter into a recession and the Fed, you can't simultaneously cut interest rates while raising them. So they're either going to have to provide stimulus or they're going to have to fight inflation. And I think I know what's going to happen is they're going to cut interest rates and inflation is going to run wild. And so the only way to fight inflation is by jacking up interest rates. Well, the Fed can't raise interest rates with this $23 trillion in debt. We're already paying $500 billion a year just to service our debt, and that's with rates at 1% to 2% that they're servicing the debt at. If interest rates had to go up to 3, 4, 5, 6%, not even the 20% that we had in the 1980s, we'd be paying trillions of dollars just servicing our debt. Federal tax revenue is only about $3.3 trillion a year. If we have to pay $1 to $2 trillion just servicing the debt, there's going to be panic. There's going to be riots in the streets. And this doesn't even account for unfunded obligations that will never be paid for. We're talking about hundreds of trillions of dollars in unfunded Social Security, Medicare, government pensions. Oh my gosh, the total federal government debt with unfunded obligations is hovering around $150 trillion. The Fed is either going to have to pick their fight. They're either going to have to jack rates to fight inflation this next coming years, or they're going to have to cut to provide stimulus. And if they do cut, the dollar's done. The dollar's never coming back. In 1971, Nixon took us off the gold standard, and ever since then, the purchasing power of the dollar has been a bottomless pit. So it'll be interesting to see how this continues to play out. And meanwhile, Trump just keeps calling for lower interest rates, but what we actually need is higher interest rates to encourage saving and investing. Moving on. Over the weekend, everyone's been talking about these California wildfires, and it's actually kind of reminding me of Katrina. With why are people building homes in areas that are prone to wildfires? You know, we had the same thing with Hurricane Katrina, where we had all these homes built in low flood prone areas, and then you take a step back and you say, who's insuring these homes? Well, no private company would ever be able to insure these loans in risky areas. No private company could compete with the government for this national flood insurance, and no one could compete to insure these homes in these fire areas of California. I mean, we have homes literally being built in deserts, in areas that are having fires every year. And the government has this national wildfire, hurricane, and flood insurance. So the government, through its good intention programs to provide insurance to these areas that the private businesses wouldn't be able to, is creating nasty moral hazard and unintended consequences. So we're building homes in areas that are prone to national disasters, and the government is bailing these people out. They're paying the home builders. Home builders are just building the homes. They're getting the money. And the only way people will live there is if they're insured by the federal government. And the federal government just comes in and bails them out with this underpriced insurance, where if you actually had to charge the market rates prone to the areas that are going to get hit with these national disasters, no one would live there. No one would live there. And the same thing is happening with student loans. Student loans have now topped $1.6 trillion. And the government is doing to college kids what they did to homeowners back in 2007. The federal government is subsidizing student loans, and they're breaking the link between risk and return. So we have all these kids, all these college students, getting these liberal arts, worthless degrees that are never going to make any money. But they're doing it on the federally subsidized government student loans. So what would happen, per se, if the government didn't subsidize these student loans? Well, you'd have to have private banks and private lenders that were providing the funds for these students to go to college. So realistically, probably what would happen is, say I'm an accounting major right now. If I wanted to get a loan to go to college, I'd go to a private bank, and that bank would assess me based on my GPA and my ability to earn a future income, which, being an accountant, there's actually a pretty good chance that I'll earn a decent income in the future. And this private bank or lender would provide me an interest rate commensurate with the level of riskiness that I am for this loan. On the flip side, for example, these English and liberal arts majors, a bank would look at them and say, well, what are you going to do once you graduate college? What are you going to do for an income? And a lot of these students have no idea what they're going to do for a job once they graduate college. They're not in there to learn. They're just in there to party and hang out with their friends. So naturally, if there's more risk, lenders would provide these borrowers a higher interest rate. Not the 3% that the federal government is providing, but maybe a 10 or 11% interest rate to take on the level of risk that it is to lending to these students to go to college, to get useless degrees where they're not going to be able to make any money. Well, it doesn't matter if you're a business major, if you're a science major, engineering, mathematics, you're getting the same interest rate as someone getting an art degree that has no possibility of ever making their money back. And this is just subsidizing people to get useless degrees, and then they're graduating and they have no chance of paying back this debt. And federally guaranteed loans in the student, it's just the same thing that happened with the housing crisis back in 2007. The government with Fannie Mae and Freddie Mac was loaning to subprime borrowers who had no chance of ever paying back these loans. They were giving them balloon interest loans with these low teaser rates on adjustable rate mortgages. They were saying, everyone, all right, you're just going to have to pay $500 a month for these first 2 years on these low interest teaser rates. And then once the teaser rate kicked off, they actually had their real interest rate, and they couldn't make the payment, so they were defaulting. Well, the same thing is happening with student loans. We're giving these kids these teaser rates that they shouldn't be getting. They're getting too low of interest rates on their student loans, and we have a crisis on our hand. We have too many kids going to college. We have too many people majoring in useless degrees that aren't going to earn them a future income, and that is how we arrived at a $1.6 trillion student loan crisis. And then you have candidates like Elizabeth Warren. Elizabeth Warren she's off the rails. She's crazy. She's saying she's going to tax the rich to pay for these student loans, and she's going to provide this wealth tax. Well, this is totally unconstitutional. It's an unapportioned direct tax, which goes against the 16th Amendment that can only tax income. And what does she think is going to happen when she taxes the rich? I see all these liberals talking about how back in the 1950s we had 90% marginal tax rates. That was terrible. And matter of fact, no one actually paid these top marginal tax rates. Everyone had deductions to take so that they weren't actually paying these high rates. I mean, you do the research and you see every doctor, every lawyer, everyone had a business, and they were using their business as write-offs. They were putting family members on the payroll. They were putting their kids on the payroll at low tax rates and just stuffing their payroll. So taxing the rich never has worked. Historically, the federal government collects about 17% of the GDP as tax revenue. It hasn't mattered if marginal tax rates are high, if marginal tax rates are low. Every year, like clockwork, the federal government collects 17% of GDP as tax receipts. So taxing the rich, it's not going to work. I mean, you saw this in France. France did the same thing where they bumped up their top marginal tax rates, and the rich just left. They left. You think rich people are just going to stay around and go, yep, I'm going to pay you all this money that I earned? Yeah, no, it's not going to happen. They're just going to move, or they're going to get deductions. And the worst part of this, of her wealth tax, is she's going to tax unrealized capital gains. Meaning if you have a stock that you bought for $100 and it goes up to $150, Elizabeth Warren wants to tax you on that $50 gain, but you haven't realized it. That's the whole point people invest, is so that they can defer their gains. So say you get taxed on that $50. Where are you going to come up for the money to pay that tax? Well, you're either going to have to use money from your job or some other source to pay the taxes, or you're going to have to sell that stock. So we're effectively forcing people every year to cash out their stocks to pay the taxes. And then imagine what happens. Say on the first year, the stock goes up to $150 and you don't sell the stock but use income from some other source to pay the taxes. And then the next year it goes up to $200 and you have to pay another $50. You're going to have to pay tax on another $50 worth of gains. So you've paid tax in 2 years. And imagine the third year, your stock goes down to $50. Well, you lost money, but you still paid taxes during the 2 years you made money. So really, you paid taxes to lose money. And I saw there was an article on CNBC talking about how under this new plan, Jeff Bezos would have to pay $6 billion in new taxes. Why are we taxing the man that has helped the world more than any other company? Amazon is one of the greatest things to ever happen to this world. The convenience it provides, I can order anything and get it shipped to me within 2 days. That is incredible. We should not be trying to punish people in punitive tax measures and getting them to pay $6 billion. And he hasn't even earned any of this income. This is just unrealized capital gains. Now, if Jeff Bezos goes to sell his stock, and realizes income, yeah, then he'll pay taxes on it. But to force people to pay taxes on unrealized capital gains, what are we going to do with people that have investment properties? Say you have 10 investment properties and the market value of these properties went up every year. Are you going to have to get these homes assessed every single year to calculate your wealth? And then say you have these 10 properties and they all go up in market value, so your wealth has gone up. To pay the taxes on this, you are going to have to sell your investment properties to generate the liquidity you need to pay the tax, which is the whole point of our tax code as it stands right now, is that you have to have a source of income to pay the tax. You have to have income. Income is taxed, not unrealized capital gains. And we're seeing fallout all over the market. Berkshire Hathaway has hit record levels of cash. They have $128 billion in cash and short-term investments. And part of this is because the Federal Reserve has kept interest rates so low and built up these asset bubbles. And with the tax cuts, all that's happening is the money that these companies saved, they plowed them back into share buybacks. Companies are buying with these cheap money, using that money to buy back their shares, which is driving up the prices of these stocks. And meanwhile, we have Warren Buffett over here at Berkshire sitting on $128 billion. And he's saying, there's nothing that I can buy. There's nothing effectively valued in the market right now. So we have the Fed creating asset bubbles, and we have people calling for lower interest rates. So it'll be curious to see what happens in these next couple years. But like I mentioned, what we need to actually happen is we need to have the Fed raise interest rates to encourage saving and investing. But that's not going to happen because then the government won't be able to service its debt. So something just to keep an eye on.